All right. Welcome to Finance 231. Welcome, Scotty. Thanks for being here during the live session. Hope you had a good holiday weekend. You feel refreshed and you're ready to go back at it now. Hopefully, everybody had a good and safe weekend. Hopefully, some of you got a long weekend and were able to relax and spend time with family. So, we'll get started tonight. We've got a few things we need to cover. Obviously, this week is midterm week, so we do have a little bit longer test than normal. This week's test is 20 questions, so double the size of last week. It is worth double the points. It's worth 100 points instead of 50 like last week. I'm going to guess that a few of you felt like we didn't do as well as we wanted to last week on the test. Although the average scores were decent, I bet some of you felt like, you kind of got tricked on the test, or, the wording wasn't very clear, something to that effect. So I'd strongly encourage you to study the material this week and take the notes like we encouraged you to last week, and then be very careful, like we talked about last week, about how the question is worded and what the answers are, and how they relate to each other. So anyway, just take your time, make sure you're in a place where you can think and have enough time to really focus on the test. I did get some very good assignments last week. Couple common things that occurred. One was, when we talked about last week, if we say that the assignment is 2 to 3 pages, that means 2 to 3 pages. That means 2 to 3 full pages of writing. It doesn't mean a title page, 1 page of writing, or 1.5 pages of writing, and then a reference page. It means full 2 pages of writing to get full credit. So a few of you got discounted slightly for short papers. There are a handful of you that didn't get the assignment in, and so I'd encourage you to get those essays in as soon as you possibly can. I do accept late work, however, for a slight discount as far as the overall score, but you'll want to make sure that you get those 100 plus points, for your final grade. So last week was a 2-page essay. This week, as far as the assignment is concerned, it's a little different. This week is an end of chapter assignment like last week, but this week, instead of writing an essay form, it actually has more to do with math and then just a couple short problems, or short answer questions. So there are 4 parts to this week's assignment. First 2 parts have to do with calculating the holding period returns of a stock, and then the second part has to do with calculating the standard deviation of a stock. And then the third and fourth parts, or the small short answer questions, are just that. A couple lines will be sufficient to answer those questions and think about those questions and give me feedback on them. So this week you may be turning in an Excel sheet along with a Word document. You're welcome to do it all in Excel or all in Word. Most people prefer to do Part A and Part B in Excel and Part C and Part D in Word, but it's up to you. The one thing I will say is that if I can't see your work or how you got to your answers, I can't give you full credit. You've got to show your work. So it's not good enough to find somebody that has answered these questions somewhere on the internet. You've got to actually figure out how to format these math problems, and Excel can help you out. Excel can make it a little bit easier to format the cells and make it look nice, but you've got to have that back information so that I can see that you actually went to the effort of putting together the equations. Okay. I can also then help coach you if you didn't get the correct answer on what to do differently when you resubmit for additional credit. And that brings me to my other point I was going to make about last week's assignment, and that is that last week's assignment, if you didn't get full credit on, you're welcome to resubmit, and I've encouraged you to do so within the feedback for additional points, like we talked about in week 1. Finally, discussion board was very good last week. I appreciate all of your comments. A few of you missed out on a few points based on just, once again, getting the content requirements as far as having enough content. If I'm going to give somebody full credit for meeting that requirement, I can't very well, in good faith, give somebody, or a good conscience, give somebody full credit for not meeting the minimum requirement. So just be aware of that minimum requirement. Make sure that you get the amount of writing in that needs to be done. And then finally, for both assignments and discussion boards, just a quick reminder on plagiarism. We talk about it a lot, and so I don't want to spend a lot of time on it. But the bottom line is, you can't cut and paste anything. onto the discussion board or into an assignment. Everything must be your writing. You are able to quote things, but just keep in mind that as a general rule, the discussion boards are set up for you to give feedback and you to give your thoughts and you to give your opinions. They're not a place for you to just regurgitate research that you find online in a few minutes of research. So keep that in mind. The thing I want to see and that most professors should be looking for on the discussion board is your feedback, your opinions. And so make sure that the bulk of what you're doing, especially on the main post where a lot of people end up with just research and nothing else, make sure that main post is a majority you're writing and a minority, things that you found online. Okay, so just as a general rule, that's just a rule of thumb on any kind of discussion board. Should be more about your opinions about the research or your opinions about the topic or experiences regarding the topic than it should be about just information that you were able to find. Okay, it's supposed to create a situation where you think through and develop opinions and feedback about the topic. It's not meant to just be an exercise in cutting and pasting things from online. Okay, that's enough about that. And then as far as the assignment is concerned, just be aware that the school, if you're not aware of this already, the school has technology that helps us to identify if a paper has been plagiarized or copied from something online. And so you don't want to get caught in a situation where the technology tells me that it was copied. Then I have to go to you and basically we have to talk through whether or not it really was or whether or not there's a glitch in the software, or whether or not we have to give you a warning on plagiarism. And if you get 2 warnings through the school, they'll kick you out of the class, give you an F, and you potentially could get kicked out of the school if you've had that issue before. So just know that the school is very, very serious about cutting and pasting, very, very serious about taking somebody else's work from online. But it's really easy to avoid that, and that is that you can do the research online, find the ideas, find the information, but then just put things in your own writing and give credit where credit's due, wherever you found the information. But don't copy word for word or cut and paste from something online. Okay, enough of that. Michael, thanks for joining. Can you hear me okay? Any questions, Michael or Scotty, about cutting and pasting, about plagiarism, about expectations for the discussion board, about minimum requirements for assignments? Any of that just doesn't make sense or that you've got concerns or questions about? I know I'm kind of putting you on the spot, but I bet if you guys have a concern, it's probably something that other people in the class probably have the same concern as well. So I'd love to address it while I've got you. All right, so one more quick thing that I failed to mention about the assignment this week. The assignment I did change the instructions on, so please note that change of instructions. And please also note that tonight all I'll be doing is briefly introducing, as I just did, the assignment. I will be posting a separate tutorial video to help you with the assignment. Okay, so there'll be a separate tutorial video. It's not going to give you all the answers, but it will give you a start and kind of give you an idea of how to do it. Now, even if you don't watch that tutorial video, you could find all the information on how to do it within the chapter, of course. They don't ever do an end of chapter question that can't be researched, and and the design of how you need to solve it can't be found within the chapter. It's very easy to find the information within the chapter, but I give you the tutorial just to give you a little bit of an extra help. I find that this assignment happens to be the most problematic or tough assignment. So just be aware of that it's one of the tougher assignments. Give yourself some extra time for this week's assignment. If you get going on it late Saturday night, I'm going to guess that it could be very difficult, or even get a situation where you might become discouraged and quit on the assignment. So start early, review the tutorial that I'll be posting, review the chapter 4, which is where that end of chapter problem comes from, and make sure you note the new instructions for the assignment. So Scotty, you took the assignment before, or took the class before? You can, yeah. So if this is the second time you've taken this class, or this is a retake, I have no problem at all with you using prior information. The issue that I need you to do, though, is, or the thing that I need you to do is to make sure that you note that in your submission. Because once again, if you've submitted something before and you resubmit it in this class, the technology that we have is going to flag it as something that's already been submitted before and has been plagiarized. So good question. Please just make sure that you note, that this is something that you did for a prior for this prior class. Now, it is still plagiarism if you submit an assignment that you did for a different class, right? But if it was the same mod, if it's Finance 231, you're in good shape. No worries there. Okay? All right, good question. Any other concerns, clarifications that we can do before we proceed tonight? Okay. All right, so those of you who are still missing your week 1 test, week 1 assignment, maybe some of your posts, use this week and next week as an opportunity to get caught back up. You definitely don't want to go into week 4 with the final and not be on target. What ends up happening that week is if anything can go wrong with computer issues, connectivity issues, family issues, health issues, work issues, they do, okay? And those of you who have been doing Steven Senegar classes for a while or Independence U classes for a while can relate, because it seems like if you find yourself behind in a class and you keep telling yourself, oh, I'll have enough time, I'll do it at the end, something tends to come up and prevent us, from being able to have the time we thought we would have. So just please, please, please get caught up as soon as you possibly can. It'll make things a lot easier. Welcome, Sabrina. Happy Memorial Day yesterday. Hope it was a good weekend for all of you. All right. So tonight we've got a couple chapters. Chapter 3 and Chapter 4 are the material for this week. Again, the expectation is that you'll read chapters 3 and 4 and that you will review the slides, which I'll post on to the announcement board, and that you'll then couple that with the notes about the midterm for this week, and that information all combined should create a situation where you'll be okay for the test. We'll spend the last 10 minutes talking about the midterm, but I will give you a preview, and that is that the first 10 questions on the test, or the first half of the test, I'm not going to review with you. And the reason for that is that all 10 of those questions happen to be, okay, similar to questions that you saw last week on the test. So instead of trying to find all new information for chapters 1 and 2 and go back and try to read everything and study everything, I will tell you or give you the hint that if you will either take your notes from last week's session where we talked about the different topics that'll be on the test and specifically focus on those, and then focus on the things that you recall tripping you up, or the things that you recall seeing on last week's test, you'll be in great shape for the first 10 questions on the midterm. Okay? All right, so let's look at Chapter 3 real quick. Chapter 3 talks about how we gather information about investments and securities. And I've already lost the... One sec. I lost our feed here, so one second. I don't know if your screen went dark or something, but let's get back to what we need here. Okay. Can everybody see the slides? Can you see the Chapter 3 slide? Okay, for a minute there, it went blank on me. So, okay. Scotty, what language is that there? Just giving you a hard time. Okay, we got 2 chapters. Yeah, don't worry about it. I was just kidding with you. Okay, so we got 2 chapters. Chapter 3 is about finding information. And obviously, it's a lot about using the internet for that information. And we're going to be talking about that quite a bit this week on the discussion board, about using the internet for trading, for investing. 3, and I mentioned this on the discussion board, 3 of the CNBC top disruptor companies for 2015, meaning companies that are really disrupting a certain industry. 3 of the top 50 companies are in the business of giving investment advice via an online website. Okay, and we call them robo-advisors, meaning there's not really a person that you necessarily consult with, as much as there is a computer program that allocates your investments for you and makes it very simple to be well diversified, well allocated in a low cost, good situation. So you can see that for me, I just think it's a personal preference thing. I think these robo-advisor sites are actually very good. I think they're a very good tool, especially for somebody who doesn't have daytime hours to meet with an advisor or ever talk to an advisor. And there are plenty of working single parents, plenty of shifts that don't allow people who work 2 jobs, people who have busy young families. there's plenty of people that cannot get away from work or family obligations, even for a few hours, to meet with an advisor. And so these online sites provide an important service to those folks, and they do a great job. They do a very good job. So I have clients, obviously, as a financial advisor, that prefer to work with me person to person, face to face, and meet with me and get advice that way. But I completely understand that there are a lot of people who would also prefer to just work online, and not ever have to take the time and effort to work with somebody face to face. Okay, so that's kind of what we're talking about in Chapter 3: is how we get the information, where we get the information. Chapter 4 talks about risk and reward, and I hope we'll get some time to cover some of the material from that chapter. Very interesting chapter. Basically, investing comes down to cost benefit. We talked about that a little bit last week on the discussion board. Investing comes down to cost benefit. That's why it crosses over with corporate leaders, right? Corporate managers are in the business of making hard decisions that come down to cost benefit analysis, okay? Analyzing the costs, analyzing the benefits, and making a good choice. When it comes to investing, we're doing the exact same thing. It's just, we call it risk reward, right? Risk is the potential cost of doing this type of investment, and reward is the potential benefit of doing a certain kind of investment, okay? And every kind of investment has that risk-reward trade-off, like we talked about last week for a few seconds on the call, right? We talked about how everything has risk and everything can have a potential reward, but some things aren't called investments because they don't have either interest, right, income, or value change potential. So getting started in investments, a lot of people just say, Dave, I'd love to invest, but I just don't know where to start. I don't want to work with a financial advisor because I don't have very much money. I just want to get started somewhere, but I don't know how to start. And the best way to get started anymore when it comes to investing is to do your research online, right? So for those people who don't have the benefit of a class like this, like you all do, and even for you all who do have the benefit of a class like this, but I'm very well aware that, you get through a class like this, get you a few months down the road, and you might have forgotten everything that we learned, right? That's just how things work. So because of that, there's a lot of great online tools, and hopefully you'll leave this class thinking, hey, if I ever want to do investing, I've got plenty of options as far as information and tools that I can find online. And we start, as far as information is concerned, with different education sites. There's a lot of different education sites. This one lists a few. I actually think Investopedia is one of the best. If you don't mind some of the pop-ups and things like that, I really appreciate what Investopedia does as far as the tutorials, the videos, things like that to help us. But there's also a lot of good YouTube videos. There's just a lot of media now to choose from when it comes to learning about investments and the basics of investing. So let's say, 3 months down the road, I completely forgot what a mutual fund is, or an exchange traded fund, or ETF, or I completely forgot what mid cap or small cap or large cap means. I can always Google those things and I can find lots of resources, or I can just go to a site like Investopedia and actually just put it into their search bar, and there'll be plenty of material that can help me from a reputable site on that topic, okay? And then sites like Fidelity.com and Vanguard.com and E-Trade and Ameritrade, these are all legitimate, good investing sites that also are highly educational and highly informative as well. So all those sites will have lots of different options as far as information that you can, feel like you're getting helped when it comes to the information as well, okay? As far as tools are concerned, there's lots of different tools, lots of different sites for that. One of the tools that I think is very helpful and that the book lists here is the FINRA website. And FINRA is the site, is basically an organization. It's the leading organization that develops rules and basically generally accepted financial advisory. It's kind of like the Financial and Accounting Standards Board, the FASB, that develops the U.S. generally accepted accounting principles that you learned about in accounting. FINRA is industry persons, okay, industry personnel. It's a self-regulating organization that develops best practices for the investment world. And then it's the SEC, the Securities and Exchange Commission, that actually does the enforcement when it comes to following the rules. But similar to the CPA side or the accounting side, where you've got the IRS, okay, and the SEC for public companies, and a lot of times, but the IRS is basically saying, did you or did you not follow the guidelines for taxes? But the FASB and US GAAP are determining, and these are industry professionals, are determining what the rules should be, okay, and what the best practices should be. So FINRA is a great site. It's got a lot of educational tools on it. One of the things that you can do on the site is you can do like a cost analysis. They can analyze different mutual funds that you might be looking at to see what the costs are that you might not be able to readily see from your advisor or from the information you're seeing. FINRA can do basically a cost analysis for you. FINRA has a lot of news articles and updates and alerts about different different investment products and the good, the bad, as far as the pros and cons of different investment options that you might see. So FINRA is a great site. It's a great opportunity. One of the other things that FINRA does very well is FINRA will allow you to do what's called a broker check, which means that you're able to research by name. It's called the FINRA broker check here on this page. You'll be able to research by name an advisor. So if you're working with somebody and you say, I just want to make sure that they've got the licensing and that they're official and, there's nothing crazy going on. FINRA, you can do a check on them. You can check if they've ever had legal history as far as lawsuits against them in the investment world. You can check what kind of licenses they have, what kinds of things they're authorized to sell. You can check who they really work for, because a lot of investment advisors have a doing business as or a DBA, to do investments, but really they might, represent an insurance company. And it might be nice to know that. I always tell people, the investment world, is similar to any other, sales world. The company that you represent, says a lot about the types of products that you'll be representing. So or that you'll hear about. So if I go to a Ford dealership, I expect to get, somebody's going to try to sell me a Ford, right? And I know that because it says right on the label of the dealership that I'm at a Ford dealership, right? No surprises. But sometimes in the investment world, people will say, people will have a company name like Wealth Advisory Services Incorporated, and if I do a broker check on them, it might say that they work for Mass Mutual or Northwestern Mutual or New York Life, big life insurance companies. And so they'll be highly focused, instead of being objective, financial planners, they might be highly focused on trying to sell me insurance. Not that insurance is bad, but it's good to know that, right? When we engage with a financial advisor, it's good to know beforehand, what their priorities are and what their biases might be. And then there's some other things that I think are very helpful on FINRA, like they'll list like the top 10, a lot of times they'll list like the top 10 scams, for example, to look out for, things that just are good information that can be helpful and help us avoid problems with investing. Zacks is another great site. Zacks has a fund screener. A lot of different websites do now, like Yahoo Money, Yahoo Finance, MSN Money, Google Finance, all these different sites have screeners, what's called a screener. And basically you're able to, based on different aspects of a stock or a company, screen for the particular company or particular mutual fund that you're trying to look for. So for example, this gives you an example here. If I wanted companies that are at a 52-week high, for example, and have a highest Zacks ranking, which is a rating service, and I want them to have significant volume, significant trading, so that they're not, just a very lightly traded issuance. I can set the screens here, and then it'll automatically go through the investing universe for me and find the different stocks or mutual funds that fit the profile that I'm trying to accomplish. So that's a great tool. A lot of different investment advisors will use a tool like that when looking at mutual funds or stocks for their clients. But a lot of clients don't know that they could actually look those up and do that basic research themselves, and it doesn't cost anything usually, and it's very simple. So you might as well do some of that research in the beginning. All right, I'm not going to go through these, but they are good, pieces of information for this week's discussion board. As we mentioned earlier, the discussion board this week's about investing online, the pros and the cons. I'll let you do that research. We won't go over that right here. We do want to differentiate between descriptive information and analytical information. Descriptive information is stuff like you'd find on Google Finance or Yahoo Finance or MSN Money, where you just basically can look up a company's public financial reporting, like their income statement, their balance sheet, their statement of cash flows. You can see a PE ratio, which is very important in investing. It's the price to earnings ratio. You can find different financial ratios. You can find, recent news about the company, things like that. That's all descriptive information that you can find that usually is free online, right? And there's plenty of different websites out there that are very good that give us free information, in part because most of them are advertising at the same time, right? Like we talked about with Investopedia, but Yahoo Finance, Google Finance, MSN Money, these are all companies that have advertising that pays for them to exist, but they also provide very important service, to us, which is free information about investments. If you go back 20 years, the only way to get that information was to subscribe to newspapers, okay, or to subscribe to periodicals that could give us that information. It just wasn't readily available. There was no CNBC on the TV. There was no internet, okay? So you basically were in a situation where you had to take the Wall Street Journal, or you had to take Investment Daily, or you had to take one of these periodicals so that you could get your information about investments. Now, this descriptive information is very easy to access for anybody. You do not have to be a financial advisor, and you do not have to pay anyone for this information. There's plenty of it out there, and it's very easy to do research now on companies. Now, analytical research is a little bit different. Analytical research is basically somebody's giving an opinion, or some companies giving an opinion on whether or not the information that they've analyzed about the company is good, bad, or indifferent. Basically, they're telling you whether or not they would suggest that you buy something, hold it, don't buy or sell, or sell it, okay? And that kind of advice, that analytical information, many times is a pay-for service. Now, you can still access some of it. For example, if you do your stock trading through a company like Ameritrade or E-Trade or Fidelity or Vanguard, they'll provide you some of those analytical services for free, but it's because you're paying, you're a member of their trading site and you do your investments through them. So they automatically add on, some of these analytical services as a free service to you as a customer. But mostly these analytical services and getting advice from like a Goldman Sachs or Morgan Stanley or Merrill Lynch, most of these companies will pay. You'll either have to be a client or you'll pay for their analysis. Okay? And it's important to know the difference between these. You'll see this on the test. The difference is one is just describing the information that the company provides, and the other is actually taking that information and then giving you feedback on what you should do as far as the investing part. Okay, helping you with your investment decision making, where the descriptive information can ultimately help you, but doesn't give any opinions on whether or not the stock is good or bad. Okay, all right. Sabrina, Michael, Scotty, any questions so far about what we've talked about? So easy to get information. You've got descriptive and analytical information. Descriptive is usually free. Analytical is usually pay for service or something that you get through having an account. And internet is a great resource as far as information is concerned, and researching different stocks, mutual funds, something to invest in. Okay, so here's some descriptive information. An example on McDonald's. MCD is their ticker symbol, but you can always look up a company's ticker symbol by just Googling the name of the company and then putting stock after. You'll almost always find it immediately through Google. So this is McDonald's. The price as of yesterday, when this was when this screenshot was created, was $93.54. But then, and this is probably too small for you guys to read, but there's lots and lots of data and information and ratios and financial statistics so that so all these different numbers can help you to analyze whether or not you should invest in McDonald's as a company. Lots of different types of investment information, sources. As we've talked about before, there's lots of different sources. This gives you lots of examples of ways. A lot of people have kind of a preferred medium, meaning they have a preference on what type of of source they use. Some people don't like to use online sources. I almost entirely, that's 99% of where I get my information as a financial advisor on investments is online. But some people like journals, some people like newspapers, some people like watching CNBC or Fox Business. So there's lots of different ways that we can get our financial information now. Lots and lots and lots. Here's some online resources. And then you've got subscription services, okay, that might cost. Here's just some symbols for some well-known companies. might be curious about. So you might say, I really like Target, or I really like, Coke. What are the symbols? Company like Coke, most people wouldn't guess that their symbol is KO. A lot of these companies' symbols you could almost guess, right? Like Walmart, WMT, or Yahoo, WHOO, or UPS, UPS, right? Or Target, TGT. But then there's some like ExxonMobil. I think XOM isn't very. You just wouldn't guess that, or Coke as KO. But anyway, those are some of the most popular companies and their symbols. You've got lots of different scam issues that can come up. I will say, though, and we're not going to go over these specifically because that's one of the things that a lot of people are going to be writing about on the discussion board this week is the potential for scams. I will say that, for people who are new to investing online, I think a lot of people will assume that there are a lot of scams with investing online. It just seems a very dangerous place to invest, having things online. Reality is, among the legitimate sites like Fidelity.com, the ones we've already mentioned, like Vanguard.com, E-Trade, Ameritrade, Scottrade, those types of sites, those legitimate sites that have been around for a long time, they spend millions and millions, and if not billions of dollars on security for their sites. And in my 12 years as a financial advisor, I have yet to hear of anyone using one of those legitimate companies, one of those legitimate sites, having any fraud issues or scam issues through those websites. I think the more common issue, so that might be what people think is going to happen to them, but that's not reality. That doesn't happen as often as people would think. What does happen quite often is people don't go to a legitimate site. They find an advertisement for something that's far too good to be true, and they want to believe in it, and they do a little bit of research, but not much, through that site that's purporting the information, and then they throw money at it. Okay, they send a check off or they wire money. That's insane. Don't ever, ever, ever do something like that. Okay, if you're going to ever invest online, use one of these legitimate trading sites. Don't ever respond to things that sound like they're too good to be true, because, as we know, most of the time that's what they are, too good to be true. And somebody internationally will end up here with your money, and you will never get your money back, and they will never find who did it. So just that's where you've really got to show some caution and some smarts, as far as internet savvy. Go to third-party confirmed and respected sites, and you'll be just fine when it comes to investing as far as security is concerned and avoiding fraud. All right. So when you're investing fraud in general, when it comes to investing, just ask yourself the following questions. Is the seller licensed? As crazy as this sounds, a lot of the fraud that goes on would be avoided if people would just do that broker check thing on FINRA. Okay? So that the neighbor who says that they've got a friend who's got a friend who's helping people invest in this great investment opportunity, when you broker check them and they don't show up as a legitimate investment advisor, that's a great red flag. Doesn't mean that the investment isn't legitimate, just means that you need to do a lot more research and make sure that you're very, very careful when it comes to that investment, because most of the fraud that occurs, once again, is outside the licensing, the proper licensing that should be happening with investments. Is the investment registered? Is an investment that's got regulators looking at it? If no regulators are looking at it, it doesn't mean that it's going to be perfect, right? Investments have risk. They're going to go up and down. But if you don't have any regulators looking at the investment product that you're buying, it's like buying medicine from an online mail order from a third world country. Okay? I don't encourage anybody to find a website, a Russian website or a Chinese website or a Mexican website, and start ordering their drugs from those websites. We can probably all agree that they'll be less expensive, right? Our medications will be less expensive if we do that. But there's no quality control, right? The FDA doesn't double check, triple check, quadruple check those medications. And you could end up with something that you didn't expect. The same thing is true for investments. If you have regulators on registered investment products, you can still have problems, but the likelihood of those problems is far reduced versus products that don't have to be registered and don't have regulators. Okay. Another question: how do the risks compare to the potential rewards? We're going to talk about this more in Chapter 4. I don't know if we'll get to it tonight, but but Chapter 4 talks more about risk and reward. It needs to make sense, okay? Investments don't exist out there that don't have risks associated with them, and especially when it comes to high reward or high potential benefit investments, they need to have high potential risk, or they're not legitimate, okay? Because the marketplace will price risk, okay? The marketplace is smart. When I say the marketplace, I mean institutions like the Harvard Endowment Fund that has over $30 billion, okay? The folks at Harvard are not dumb, okay? If there's something that's really good out there that pays a good return, then they're going to buy it to the point where it prices adequate for the risk that they're taking, okay? And they're going to measure that risk. Or the CalPERS Fund, which is the pension plans out of California, billions and billions of dollars. They're very smart people. They have a team of people. They do their research. They analyze the risks and rewards associated with investing. And if the rewards seem too great for the risks that they're taking, they'll usually shy away from those types of investments, because if they can't understand why the risk isn't priced how it should be, they won't do it. What I find with a lot of individuals is we say, if the risk is really low and the reward's really high, that's a good thing. In reality, it's a potential for a scam, okay? Because risk and reward go hand in hand. Things that pay off significantly need to have substantial risk, or they're not priced correctly and there's potential for scam, okay? All right, enough on that. That was a lot of soapbox about scams and what you should avoid. You also need to obviously be able to understand the investment. If you can't get your mind around the basics of the investment, I don't mean you need to become a specialist or know everything or know all the details, but you need to know the basics of it. If you don't feel comfortable understanding how the investment's going to make money, don't do it, right? Don't do it. And then where can you turn for help? So if you're going to do an investment and you're not really understanding, or you don't feel perfectly comfortable, know that there are a lot of third-party websites. You know, a lot of people that get scammed, if they would just Google search what they're looking at doing, they would find all kinds of feedback that would help them avoid problems. So, for example, 20 years ago, when Nigeria email scams first started, there wasn't a lot of feedback on that. But very quickly, there started to be a lot of literature online about these, Nigeria email scams, right? And so most of us have heard about that now, and most of us wouldn't fall for that. But if somebody knew, if somebody got an email like that, instead of just sending money off, if they just did an internet search, they would find, they would find some prevention if they were willing to do that research and read about it. Okay? All right. And then if you all ever have questions down the road about somebody, the an investment product of some kind that somebody's trying to pitch you, I am always willing to take an email or a phone call from somebody, no matter who they are, no matter whether or not they're clients or not, because I just feel like, being in the industry, that's something I need to do. So if you have any questions or concerns about a product or service that seems too good to be true, you're welcome to email me just the basics of it, and I'll do some research and see if I can't give you some feedback. Okay? And if it's not me, find somebody else that you trust, that knows a lot about finance and a lot about investments to do the same kind of thing for you. All right. I want to now skip over to chapter 4 briefly. Wrong one. 1 second. Okay. So the question is, can you see returns and risk? All right. So we're going to just spend a few minutes, that's all we have, talking about returns and risk, and then we'll get you to the test and go over those last 10 questions. As I mentioned, the first 10 are very similar to stuff you saw on the first week, the week 1 test. So we talked about return in week 1. We talked about how return has to do with 2 different parts. It's got both income or interest or dividends, however you want to call it, but it's the income, the systematic or periodic money that you're accomplishing or getting from the investment. So if it's a stock, I might get a dividend on an every 3-month basis. It's income that I receive. If it's a CD or savings account, I might get income every month, right, from the interest. So that's the income part. Then I've got the capital gains or losses part. That's what we've been referring to as the value component. So if I buy a rental property, I've got the property itself that can go up and down in value, right? I could buy the property for $100,000. It could be worth $110,000 in a year, or it could be worth $90,000 in a year. Property values can go up or down, right? And that up or down movement is that second component of return, that value change or capital gain or loss component. But then I also have the rents, right? And the rents would be considered my income. So total return is the combination between the income and the gains on an investment. All right, so why do we even care? Well, it's important to be able to measure rates of return so we can understand how fast we can grow our assets. It's also important to understand total rates of return because, as I mentioned earlier, without doing a lot of research on the risk associated with an investment, we can learn a lot about an investment based on the expected total return. If the expected total return is very high, then we'd expect the risk to be higher. If the total return is very low, we would expect the total risk associated with that to be lower, right? Okay. So we've got internal and external forces when it comes to return, and I'll let you look at those. We've got some statistics here that I think are very interesting. Okay, these are returns that go back, let's see, how many years? Well, over 100 years, 110 years. Okay. So from this page right here, somebody tell me, just by eyeballing the numbers, are there any of these countries that average higher inflation than their stock prices? So their stock price growth is on the left side, their inflation levels are on the right side. Do any of the countries have an average inflation over the past 111 years that exceeds their average stock returns? That's more than their average stock returns. So just eye down that list. Yeah, I don't think there are. So you can deduct from that or deduce from that at least 110 years of history, a lot of different countries we're looking at here, okay? You can deduce from that that stocks are a very good inflation hedge, meaning over the long term, you will usually, and if you hold them long enough, you will always, at least the last 110 years has played out this way, you will always, over the last 110 years, if you hold your stocks long enough, outpace the rate of inflation, even if the rate of inflation is quite high. If you look at Italy's rate of inflation, they've averaged an 8% inflation rate over the last 110 years. That's a very, very high inflation rate. But their stock prices have averaged over 10%. So have they outpaced the inflation rate? They have. If you look at their short-term government bonds or their long-term government bonds, neither of those have outpaced inflation. So if you're sitting in bonds in Italy, on average, you're losing purchasing power, meaning the value of your dollars, even invested in bonds, are actually losing purchasing power. They're losing value. Okay. If we look at the USA, okay, the bottom one on the list, stocks over the last 110 years have averaged 9%, which means that you'll double your money on average every 8 years. Okay. On average, every 8 years, you'll double your money in stocks. Long-term bonds average 5%, and short-term bonds average 3.9%. Both of which, and this speaks to the strength of a country's economy, if their average short-term bonds and long-term bonds exceed their inflation. And you see that most countries that is the case. Okay, and a lot of these countries have very stable, good economies, and so their inflation rates are less than their long-term and short-term bonds, which is a healthy thing. You should be able in a country to invest in bonds and outpace inflation as a conservative investor. Any questions on this one? I think this is helpful. I think I would like it even better if it showed things like gold and silver, real estate, some other investments that people like to see. I'd like to see a long-term average on a one-year CD or savings rate. For comparison purposes, because I think it'd be very enlightening. A lot of people come into my office and say, hey, should I invest in gold? Should I invest in real estate? Should I invest in, just put my money in a CD? The long-term averages over the past 111 years would show that stocks outperformed real estate, outperformed gold, outperformed cash, like CDs and savings accounts over that period of time. Now, any given 3 or 5 or 10-year period of time, you can have different winners, right? But if you go long term, stocks are a very good performer because they just represent businesses, and businesses are taking risk and trying to grow as fast as they can. And because of that, you get a market that grows fairly quickly. Okay, enough on that. So we know that there's a time value of money. We know $1 today is worth more than $1 down the road. We know that we can measure return based on a holding period return. That's what we're going to be doing on the assignment this week. We're going to be calculating the holding period return. Now, let me give you a quick example of holding period return and what you'll be doing on the assignment for this week. Okay. If I have a stock that's worth $20 today and a year from now it's worth $22 and it pays me a dividend, okay, of $2, okay, what is my HPR, or my holding period return, for that 1 year period? How do I calculate that? Well, what I do for this week's assignment as well, for the stocks that you have to calculate the holding period return, is I take the difference between these two numbers. So how much did I grow? I grew by $2, right? I'm plus $2. And then I got another plus $2 in dividends. So my total holding period return, my total return is my value change, right, plus my dividend. So that equals plus $4. Then I take that and I divide it by my original stock price to see how much I grew by. So 4 divided by $20 equals, anybody want to guess? A 20% return, okay? Because I got a 10% return on my gain here, my capital gain, and I got a 10% dividend over that year. So my total holding period return, or HPR, for that particular stock for a year was 20%. Now, we all know that stocks can go down as well, right? So let's say we go from 20 down to 16. We still get a dividend, but let's say our dividend is only $1 now. Okay? So I do the same process, though. I take the difference of my beginning to my ending value, which is -4 this time. I add it to my dividend, which is +1, and that gives me -3 as my holding period return, right? But how do I calculate in percentage form? I put 3 over 20, okay, which was my original value, right? 20s, I always divide by my original value. That gives me 15%, but it's negative, right? So it's a negative 15% holding period return for the stock that went down $4 from 20, but still got a dividend of $1. Okay? All right, so that's how you calculate holding period returns. That's what you'll be doing on part A of this week's assignment. So it's good to get a start there on that. All right, let's go through just a few more slides. I think we have a few more minutes that we can do that. It gives you some examples, gives you some pros and cons, gives you a way to calculate it just on your calculator. Excuse me. Okay, gives you more samples, and then we get to risk. Okay. One of the most important things, and I mentioned this last week when it comes to investing and doing a good job as an investment advisor and doing a good job as a consumer of investments, is understanding the risk that we should be taking with our investments. So a lot of people will say, I'm conservative, therefore I should only have conservative investments. And reality is, many people who are very conservatively minded are very aggressive with their investments, and many people who are very aggressive minded, have aggressive personalities, are very conservative with their money. There are a lot more issues at play than just what their personality is, although personality is a big part of it. Okay? One of the biggest issues is time frame, because when it comes to stock investing and bond investing and any kind of investing, really, it's more about time than it is timing. Okay? It's more about time than it is timing. It's not necessarily when you get in and when you get out. It's more about how long you have the investment. We've talked tonight about different averages, right? Bond averages and stock averages for those different countries, going back 100 years worth of information. And those returns look pretty good, right? If we could get 5% every year on long-term bonds, or if we could get 9% every year on long-term stocks, as it shows that we can in U.S. stocks and U.S. bonds, I think most people would invest. The problem is, or the problem arises with most of us, that we don't have much patience for the up and down part, the fluctuation. So what that chart doesn't show that we looked at earlier is the risk. Okay, so to get that 9% average return that the stock market in the US has gotten over the past 110 years, we have to be okay with the roller coaster ride that is the stock market. Ups and downs, dramatic ups and downs, sometimes significant downs, and sometimes significant ups, but a lot of movement, right? A lot of ups and downs. And that, in a nutshell, is the risk associated with the market. It's not that your investment's going to go to zero. A lot of people think when I say risk, I'm talking about them losing all their money. That's not the kind of risk that I'm talking about when I put together a diversified portfolio for somebody, because historically, those diversified portfolios have never gone to zero. Okay? Great Depression, Great Recession, they never go to zero because they're actually representative of property, right? Property that has value. Now, can they go significantly down? Yes. Can they go significantly up? Yes. Are they going to be moving around a lot? Yes. So that fluctuation risk is the true risk for most people when it comes to investing. Can you handle the ups and downs associated with the market? If you can, then you can assume the risk associated with investing. If you cannot handle it, and it doesn't mean that you're, like I say, either conservative or aggressive. It's just some people can invest and some people it's not for them and they shouldn't do it. And it's not that it's not good for them or could be good for them. It's just that they get themselves into a situation where they get out when things get tough, and that's where the market really beats you up, and that's where you lose money. You don't lose money in the market if you stay with it. You lose money when you get out at the wrong time. Okay? That's when you lose money. And it's similar, I use the roller coaster analogy a lot with investing. It's pretty exciting, actually, investing is, but it's only exciting if you stay on the roller coaster, right? If you're heading up, okay, on a roller coaster and it's going slow, right? Theoretically, you could climb out on the upward, and most roller coasters are going slow enough on the way up that you could get out, okay? Same is true for the market. When it's going up, that's when you should get out if you're going to get out. But you sure as heck shouldn't get out when it starts going down, right? Because it's fatal from an investing perspective. If you wait for the market to go down and then you get out, it'd be fatal on a roller coaster, and it's fatal to your investing, success to jump out when things are bad. That's the exact opposite of what you should do. Okay? All right, so that's risk. Risk is an important, critical part of investing. Hopefully you feel like you have a little bit of a start as far as information about how to evaluate risk. And of course, chapter 4 has a lot more information that I'd encourage you to read because I think it's critical. I think risk reward, as we've talked about before, is just such a significant part of investing. It should be looked at. All right, so this week's test has 20 questions. The first 10 are very similar to the 10 that you saw in last week's test, so I'm not going to spend time on them. And number 11 on the test, you'll want to know the difference between commissions between online brokerages and somebody that you call on the phone, okay? Somebody that you call on the phone versus doing an online trade. Which one charges more? Which one charges less? You'll find that in the text this week in the chapter. Make sure you know it before you get to the test. The next one on the test asks, basically asks you to understand whether or not online trading has reduced the cost and increased the speed of transaction. Has online trading reduced cost and increased the speed? You'll find that in the chapter, and you'll want to know that, before you get to the test. The next one on the test is asking you basically to understand the difference between informative information, investment information, and descriptive and informative information versus analytical information. Remember, analytical information is usually pay-for service. It's when somebody's telling us whether or not to buy or sell a stock. Informative information or descriptive information is just information we can find for free without having to subscribe to anything. We can just find that information very readily on the internet. So make sure to understand that for number 13. Number 14 on the test just asks us whether or not we can use the internet for developing a plan, analyzing goals, all those kinds of things. You'll want to know whether or not the book feels like the internet is a decent place for those kinds of things before you get to the test. Make sure you understand for number 15 on the test what the power you have when you're inputting a stock trade to either stop the trade or reverse the trade after you've put it in. And you'll want to know whether or not online trading allows you to basically pen to trade. Reality is when you go in and click submit and confirm on a trade, it's done. It's immediate. You've got that stock. So if you put in the wrong symbol or if you put in the wrong amount or something like that, too late once you hit submit. Got to be very, very careful, okay? Because what you'll end up doing is if you made the wrong choice or you made the wrong decision or did the wrong thing, you've got to go back in and trade it again to undo it, basically. So if you bought something you shouldn't have, you got to go back in and sell it. And every time you buy or sell, right, you're paying a small commission. And so you don't want to be in a situation where you have to do that. But there's no way once you hit submit and confirm on a trade to rescind it. You can't go in and take it back. Yeah, and Michael, good point. Bill pays the same way. It's also the same way when we send a wire, right? If we send a wire, that money's out of our account, and once it's sent, right? So if we send it the wrong account, sometimes the bank can try to help us to go back to the client that we sent it to incorrectly, something like that. But really, once you've pushed send and they've done the submission, it's the same thing on the stock side. You got to be done. You got to know that's right, or you got to go in and fix it, which takes a long time. And it's not about making it like it didn't happen. You have to actually go in and just try to correct your problem. Okay, so it's a little different. Make sure you understand the difference between a stated interest rate and an effective rate. Meaning, if you've got a stated rate of 8%, but it compounds on a monthly basis or quarterly basis or semi-annual basis, you've actually got a higher effective annual rate than what that stated annual interest rate is. Just make sure you understand the difference between those two. That'll be in Chapter 4. Know that they are different, right? A stated interest rate could be not very, but slightly different than the actual interest rate associated with a loan or with an investment based on how often it compounds. Because compounding interest and time value of money works for us or against us depending on whether or not it's an asset or a debt. Make sure you understand the definition of discount rate, okay? For one of the problems on the test, what is a discount rate? Make sure you understand why a discount rate is used. These are time value of money concepts, but they have to do with return, which is what we were looking at the beginning of Chapter 4. So you'll want to understand discount rate for those two. You want to make sure you understand what affects the required rate of return. So when I invest in a stock or a bond, I'm going to have some required rate of return, okay, some threshold that I've got to get from that investment over time, or I'm not going to do it, right? Because if I could put my money in the bank and get 5%, why would I go and invest in a stock that's going to be volatile for just 5%? I've got to have a required rate of return that gives me more than my bank account, or I won't do it. Right? So that's the basic concept of required rate of return. Make sure you understand what the book has to say in Chapter 4 about what different issues affect your required rate of return. Okay? So have a working knowledge of what affects the rate of return or required rate of return for investing. And number 20 on the test, you'll want to understand what types of things will affect your rate of return on your investment. Okay, so what kinds of things can change your rate of return on an investment? Obviously, if a company does poorly or a company goes into bankruptcy, that has a significant impact on your rate of return. But there are also other issues that the book talks about in addition to those that I just mentioned, and it would be good to have a working knowledge of those before you get to the test. That'll help you out. Okay, so those are the last 10 problems on the test. Like I say, the first 10 are very, very similar, if not identical to what you saw last week. So you should be in good shape for those first 10. Any questions or concerns before we wrap up tonight? Okay, look out for that tutorial on the assignment. If you get stuck on it, though, zip me a quick email. That'd be fine. Or go to the tutoring. I've posted her information for this week. She'll be in, I think, on Thursday, if I'm not mistaken. So she could help with the assignment as well. But definitely read the chapter and review the tutorial before you use the tutor's time or before you start trying to get one-on-one time for help on it. The tutorial, between the tutorial and the book, should give you a good starting point for the math part anyway on the assignment. Have a great evening tonight. Thanks for coming. Sabrina, Michael, Scotty, have a great night. Have a good week, and we'll talk to you later.